There is an easier way to invest that takes the stress out of picking stocks, and it can actually help you get higher returns. In this video, I'll show you how investing in ETFs takes the stress out of investing and helps you make more money on your portfolio. You'll see how to pick the best ETFs, and then I'll reveal 3 exchange-traded funds every investor needs to buy. We're talking ETF investing today on Let's Talk Money. Hey Bowtie Nation, Joseph Hogue here with the Let's Talk Money channel. I want to send a special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. All you out there in the nation, you know I like to make investing as easy and stress-free as possible. You've got enough to worry about. I want to give you the tools to put your money to work without worrying if it's going to be there when you need it. And one of the best ways to do this is through ETF investing. Investing part of your money in exchange-traded funds for that set-it-and-forget-it strategy that, besides giving you that stress-free way to invest, can actually help you pick better stocks to buy as well. I'll include timestamps in the video description below, so if you want to skip around a little bit, but make sure you watch those points on analyzing ETFs because there are a lot of funds out there and not all of them are created equally. An ETF, or an exchange-traded fund, is just a group of stocks or investments held by an investment manager according to a theme or a sector. The manager or investment company then sells shares of that fund, so investors get a fractional ownership of all the stocks held. I've seen ETFs with as few as a couple dozen stocks and some with as many as a few thousand stocks or bonds. For example, the SPDR S&P 500 ETF, ticker SPY, holds all the stocks in the S&P 500 index, the largest companies based in the United States. Buying a share of that fund means you get a piece of every single stock in the index. Shares of Apple, Microsoft, Amazon, and Johnson & Johnson, and a return that follows that broader market exactly. ETFs are similar to mutual funds, but are kind of like an evolutionary step in investing. When mutual funds first came out in the 60s, they went a long way to open investing up to everyone, but had a lot of disadvantages. ETFs were created to answer for these weaknesses. Compared to a mutual fund, that average exchange-traded fund is going to be less expensive to hold. The average fee you pay each year to the investment manager is about a fifth of what you'd pay for a similar mutual fund. ETFs are also faster to buy and sell. They trade just like stocks and can be bought in seconds versus a mutual fund where you might have to wait till the end of the day to get a price. ETFs cost you less in taxes as well. You only pay taxes on an ETF when you sell or when you get a dividend, but you might have to pay taxes on a mutual fund every single year, even if you keep investing in the shares. Besides just those benefits over mutual funds, ETF investing gives you an investment in an entire asset, theme, or a sector without having to pick all the stocks in it. This is that broad, macro-level investing idea that I love to use for my own portfolio, finding those universal forces and investing in the themes of the groups that are going to benefit. For example, as interest rates start to fall, maybe you want to invest in stocks of the utility sector because those lower interest rates are going to mean more attractive dividend yields for the stocks in the sector. But instead of sifting through the financial reports all day long to try to find the best companies, you can just invest in the Utility Select Sector SPDR, that's ticker XLU, which holds 28 utility companies in the S&P 500. ETF investing is also a great way to get a stress-free, low-cost investing strategy, something you can set up and never have to worry about. In fact, later on in the video, I'm going to show you 3 funds that could be your entire investment portfolio. Just 3 ETFs to buy to make your money work for you. My favorite way to use ETFs, though, is as part of a core satellite approach. Now, this is where you invest most of your money, between 50 to 70%, into a group of 3 to 5 ETFs that give you broad exposure into the assets and the market. That core portion of your portfolio gives you a diversified selection of stocks, bonds, and real estate. You then take the rest of your money and invest it in a small handful of individual stocks, maybe 8 to 12 stocks at the most. And this ETF strategy works on a couple of different levels. First, you get that broad investment through these funds. You get investments in all the asset classes, the themes, and the sectors that you're looking for. Now, this money is diversified. It's less risky because it's spread across the hundreds of stocks, so you really don't have to worry about it. It's going to churn out that market return every single year. But it also gives you that opportunity to make the higher return on that small group of individual stocks. Because you're limited to how many stocks you can buy, you're only focusing on the very best companies. You're not spending hours analyzing stocks every week because you've got your favorites and you don't need to chase every hot stock you hear about. But you know what we say here in the nation, it ain't all rainbows and unicorns either. There are some downsides to investing in ETFs. Now, one risk is that you're going to have too much of your money spread across too many stocks in the funds and that you're not able to get more than a market return. You're basically too diversified with too little in individual stocks to make a difference. Now, this is why I love that core satellite approach, because you can use that 30% of your money, 30% to 40% of your money to boost your returns through those individual stocks. Another drawback here is the expense ratio that you pay to invest in these funds. Now, I'm going to show you 3 funds with annual fees so low that they're basically nothing, but some funds can be really expensive to hold. And these are usually special themes like investing in alternative investment funds or ones where the manager is actively trading the stocks nearly every day. While the best ETFs will charge an expense ratio less than 0.5%, you see here some ETFs can charge as much as 3% and higher to hold those funds. One more drawback here, and then we'll get to how to pick an ETF, but some of these can get overly complicated and really involve more risks than investors understand. There are ETFs that use options and futures derivatives to really leverage those returns higher. These are usually called those ultra funds or 2 or 3x. Then there's also the closed-end funds that use leverage and aren't traded like ordinary ETFs. But both of these types are usually extremely expensive and not good for that long-term investing strategy. So let's look at how to analyze an ETF. Then I'll show you those 3 best ETFs to start your portfolio. Now, going to the website for any ETF, you'll see fund-level analysis of all the stocks, including a PE ratio, number of holdings, and the return over different periods. Now, because most funds hold dozens or even hundreds of stocks, the analysis that you're going to be doing really is that bird's eye macro level on the theme or the group. For example, the SPY fund tracking stocks in the S&P 500 holds over 500 stocks, with even the largest weighting, shares of Apple, only accounting for about 6% of the fund. So the effect on returns from any one particular stock isn't going to add up to much, and you really don't need to analyze those individual stocks in the funds. Instead, what you're going to be doing, you're going to be looking at that bigger picture economic forces that are going to be driving the entire group. How will those forces affect the stocks in the sector or that theme? That's going to be a big factor in how we pick an ETF to buy as well. And when you start looking for ETFs to buy, you're either looking to fill gaps in your existing portfolio, or you're going to be looking for investing themes that might do well. So as an example, maybe you're looking through your portfolio and you notice you don't have any bonds or real estate exposure in your investments. Maybe you also notice you only have tech stocks, so you want to diversify into some of those other stock sectors. Because of course, if your portfolio is so concentrated into just one sector or one asset class, you're going to run the risk of missing your goals when the market turns against that one group. Now, we're talking about here creating a diversified portfolio around the 3 major asset classes and around sectors or groups within each. Or like we talked about, maybe you see something in that broader economy or those universal forces that makes you think that a particular investing theme is going to do really well. For example, when the lockdown started, I was looking at stocks that would benefit from connectivity or those in the remote workspace. Now, I could have searched through thousands of financial reports, thousands of stocks to find those that could do really well, or I could just invest in a group through an ETF, something like this Global X Cloud Computing ETF, ticker CLU, that has outperformed the market by 45% over the last year. And once you've found that theme or the ETF idea that you want to invest in, then you need to pick an individual fund from those available. For example, a quick Google search for cloud computing ETFs shows me 4 funds in the theme. And there's going to be 3 things you want to look for when picking an ETF. That's going to be the expense ratio, dividend yields and returns, and then the fund portfolio itself. The expense ratio is going to be by far the most important. The returns on most funds in a specific theme or a group are going to be pretty close together. They all follow the same stocks in that group or the sector, so you'd expect them to be relatively similar in terms of return, but how much you keep of that return is going to depend on how much the fund charges. For example, going back to our 4 cloud computing funds, there's a 0.25% difference between the funds with the highest fee and the lowest. Now, that might not seem like much, but it's $250 a year on a $100,000 portfolio, and it's going to add up over the years. You out there in the nation know we're all about dividends here on the channel, so I'll usually also look at the dividend yield and the total return on funds as well. Of course, you don't want to sacrifice all your price return just for a dividend yield, so I usually like to look for funds that are paying out a decent dividend, but also able to grow that share price. Finally here, I'll just compare the portfolios of the different funds available. Now, the website for any fund is going to show you the portfolio holdings along with the percentage of the fund in each stock, sector, or even by geography. So here I'm just looking for ETFs that aren't too heavily weighted in one particular stock. And if I just wanted one stock to be a large part of my portfolio, then I would just buy that stock. The idea here is to get that broader exposure to the whole investing theme or the sector through each stock in the group. Now, you've got everything you need to pick the best ETFs, but I want to get you started with 3 of my favorites. These three funds are going to give you broad exposure into the three major asset classes, stocks, bonds, and real estate, and at a lower cost and produce a higher cash flow than other funds. And our first ETF is a great dividend stock fund, the SPDR Portfolio S&P 500 High Dividend ETF, ticker SPYD. The fund is designed to invest in the top 80 dividend-yielding stocks within the S&P 500 companies. So these are the highest-yielding stocks among the largest U.S.-based companies. And here you see the sector breakdown within the fund, and pretty heavily weighted to financials, real estate, energy, and utilities, which really shouldn't come as a surprise since these are the sectors that typically pay higher dividends because of those stable cash flows. Now, against that heavy exposure to just a few sectors, the ETF is actually pretty well diversified across individual stocks, with no company accounting for more than 1.5% of assets. What I really like about the fund, though, is its dividend yield and the expense ratio. The SPYD pays a 6.1% dividend, about 3 times the average yield on the broader S&P 500 index, and charges just 0.07% annually. Now that means you're paying just 70 cents for every $1,000 invested in this high-yield fund. So definitely some good reasons to consider this one. You get a high dividend yield and exposure to that upside in stocks at an expense ratio that's basically negligible. Now the downside in this one, of course, is that weighting to those sectors. With 42% of the fund in stocks from financials and real estate, then another 22% in just energy and utilities, you're at the mercy for whatever happens in those 4 sectors. And of course, with the weakness in financials and energy over the last year, that means this fund has underperformed the stock market by pretty badly, by about 35%. Now that could also mean that it bounces back for some pretty healthy price gains if those 2 sectors can stage a rebound. Next is an ETF favorite of mine, the Vanguard Real Estate ETF, ticker VNQ, and its 4% dividend yield. Those of you in the nation know I'm a big believer in real estate. It's where I got my start as a commercial real estate analyst and with my own rental properties, and there is no other asset class that has created as much generational wealth. The Vanguard ETF invests in 181 individual real estate investment trusts, that's REITs, as companies that own commercial real estate in every property type and throughout the country. It's well diversified across those property types, so office, retail, industrial, healthcare, residential, and companies that own several of those types. And not only does real estate produce a solid cash return, paid out in that 4% dividend yield for the fund, but it's also a great diversifier from those risks in stocks. Real estate values aren't tied to the same economics as stocks, so you don't get both of them crashing at the same time. The fund has produced a 9.7% annual return over the last decade, though it has fallen to about 7% in the last year. Besides that tourism-related and the retail sector REITs that are taking it this year, the office property market is struggling under that work-from-home momentum. Still though, the property market is still really strong, and there could be some good value in a few of these property types just waiting to boost the shares higher. The expense ratio of just 0.12% is extremely low, and you get that 4% dividend yield while you wait. With this next ETF, the SPDR Bloomberg High Yield ETF, or ticker JNK, we've got exposure to all 3 major asset classes. So we got exposure to stocks with that dividend fund, and then real estate with the VNQ. And here we're going to get exposure to the third asset class, fixed income or bond investments. And actually, these non-investment grade bonds are something of a mix between the safety of bonds and the upside in stocks. You see, when a company issues debt, the bonds get rated according to different financial risks. The really strong companies get what's called an investment grade rating. That's BBB or higher, while the riskier bonds get a non-investment grade rating or a junk rating. The truth is, though, that even these lower rated bonds have very low defaults, averaging less than 5% and pay much higher interest rates, so you can actually produce a solid return along with much less risk compared to stocks. You see the sector exposures here, with the fund diversified across bonds of consumer goods companies, communications, energy, and 11 other groups. And the reason I like this fund versus maybe some of those other bond funds is because investment grade funds like the BLV or the BSV, that's 2 other Vanguard bond funds, have had a really strong year. Here you see the 3 funds, the JNK in green with a 5% loss against a 3% gain on the BSV and a 10% return on that Vanguard long-term bond fund, the BLV. Nation, a 10% return on an investment grade bond fund is insane. Interest rates have sunk so fast that investors are just rushed out into these bond funds and there isn't much value left. That high-yield bond fund, though, the JNK, because these companies are more susceptible to a recession, hasn't performed as well, and I think there's more upside along with that dividend. So with this one, you get a 5.8% dividend yield and a fairly low 0.4% expense ratio. And the one downside I do want to point out, though, is just like we talked about. Because these companies are riskier in terms of finances, the fund is going to underperform during a recession, but are going to give you a better upside as the economy improves. Click on the video to the right for my 3 favorite monthly dividend ETFs, 3 of the best ETFs that put cash in your pocket every single month. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.